Bitcoin was supposed to be the escape hatch, the clean break from a system you'd stopped trusting. You saw the debt, you saw the money printing, you saw a financial system that punishes savers and rewards leverage, and you got out. You bought it, you moved it off the exchange, you wrote your seed phrase down, maybe stamped it into steel, maybe split it across 2 locations. You did everything the forms told you to do. You feel safe. Here's what nobody told you. Bitcoin is not a plan. Bitcoin is an asset, and an asset without a structure around it is just a very valuable, very exposed target sitting in the dark, waiting for a tax authority, a courthouse, or your own mortality to find it. Nobody sells you the structure because there's no exchange fee attached to a properly drafted trust, no spread to capture on a set of written instructions sitting in an attorney's file. The entire industry around Bitcoin is built to help you acquire it. Almost none of it is built to help you keep it, transfer it, or survive what happens after you're the one holding it. So here are 3 questions worth sitting with before you keep scrolling. If you disappeared tomorrow, could your spouse actually reach that wallet? If the reporting rules changed under your feet, would you even know? If your home country decided your net worth was now its business, would your coins be somewhere you could move? Self-custody answers exactly none of these. It solves one problem: the exchange can't lose your coins for you, and leaves the other 3 completely open. By the end of this, you'll have the answer to all 3 and a way to close each one, starting with the one most people never even think to ask. I'm Dr. Ben, and this is Wealth Forge. If this is your first time here, welcome. We don't do hype, we don't do price predictions, and we definitely don't do to the moon. We build. We don't follow the market, we design the moat. In a world of followers, we are the architects of our own freedom. Say that back to yourself in 6 months, once you've built what I'm about to show you, and it'll mean something completely different than it does right now. Owning the asset was never the finish line, it was the starting gun. Question 1. What happens to your Bitcoin the day you're not the one holding the keys anymore? Whether that day comes from bad luck, bad timing, or simply the ordinary fact that nobody lives forever. Right now, by most serious estimates, somewhere between 15 and 20% of all the Bitcoin that will ever exist, something in the range of 3 to 4 million coins, is sitting in wallets nobody can open, not hard to open, not open with the right lawyer, gone, permanently unreachable. A man in Wales threw out a hard drive holding 8,000 Bitcoin during an office cleanout, and it's sitting in a landfill to this day. A software developer forgot the password to an encrypted drive holding over 7,000 Bitcoin and had a limited number of guesses before it locked forever. And in one of the more sobering cases, the founder of a Canadian exchange died suddenly holding the only access to well over 1,000 Bitcoin that belonged to his own customers. No backup, no shared access, no plan. The technology worked perfectly. The architecture around it was empty. That's the part worth sitting with. None of this is a fringe problem confined to early adopters who don't know any better. One recovery-focused estimate puts the realistically recoverable portion of that lost supply at only around 2.5%, meaning the overwhelming majority of what's gone is gone permanently, no matter how good the forensic work gets. And here's the part that surprises people. Most Bitcoin owners aren't even having this conversation because most retail holders never touch self-custody. They keep their coins sitting on an exchange where a third party holds the keys on their behalf, which is a completely different risk profile. That risk showed up in the most public way possible when a major exchange collapsed almost overnight and customer funds that everyone assumed were simply sitting in individual accounts turned out not to be there. Self-custody exists specifically to remove that particular risk. What it doesn't do is remove risk altogether. It just quietly hands the single point of failure back to you, the individual, instead of a company with a balance sheet and a compliance department. That trade can absolutely be worth making. It's just not the finish line people treated us. Self-custody culture repeats one phrase constantly in every comment section, as if reciting it is the same as being prepared. Not your keys, not your coins. True. Also incomplete. The moment you become the sole point of failure for an asset, you've traded counterparty risk for a different risk, the risk that you are the single thread holding the whole thing together, and threads break.
And architecture isn't about distrust of Bitcoin. It's about admitting you're mortal, forgetful, and occasionally hit by a bus. An architect plans for that. A follower just hopes it doesn't happen to them. Now, the good news, this is the easiest of the 3 gaps to actually close. It requires one shift most holders never make. Separate holding the asset from being the only person who knows how to reach it. Picture a simple 2 of 3 arrangement. You hold one key on your own hardware device. A spouse or adult child holds a second key in a separate location. A licensed custodial service holds the third purely as a backup signer. No single person, including you, can move the funds alone, and no single point of failure can freeze them either. It helps to understand what you're actually protecting before you decide how to protect it. Most hardware wallets generate a 12 or 24-word seed phrase, and that phrase alone is the entire key. Anyone who has it can move your coins, and if it's destroyed with nothing else backing it up, nobody can, including you. Paper degrades, floods happen, house fires happen, which is exactly why stamping that phrase into steel has become such a common practice. It survives conditions a piece of paper simply doesn't. But a single steel plate in a single location is still a single point of failure, just a more fire-resistant one. That's where an approach called secret sharing comes in, where the phrase itself is mathematically split into several pieces, and only a minimum number of those pieces, say 3 out of 5, are needed to reconstruct it. No individual piece reveals anything on its own. Lose 2 of the 5, you're still fine. Someone finds 1 of the 5, they have nothing usable. It's a different mechanism than the multi-signature setup, but it solves the same underlying problem from another angle, and some holders layer both. There's also a newer category of tools worth knowing exists, even though the space is still maturing. Automated transfer mechanisms, sometimes called dead man switches, that check in with you on a schedule and only release access instructions to a designated person if you stop responding for a defined period. They're not yet a substitute for a properly drafted trust or a documented plan with real legal teeth, but they're a useful supplement, especially for the gap between today and the day you finally get the paperwork done.
Or picture a sealed set of instructions held by an attorney or executor that contains no keys but tells your family exactly what they need: which wallet software, which device, where the backup phrase physically lives, who to call first. Or a trust that actually names the digital assets by category and gives a successor trustee explicit authority to deal with them, instead of leaving your family to find a hardware wallet in a drawer and assume it's junk. None of this is exotic. It just has to exist somewhere other than only inside your own head. And it has to be tested once with a trusted person actually walking the recovery steps while you're alive to catch the gaps yourself. One mistake worth naming directly: relying on a single written note tucked inside a will. A will typically becomes a public document once it's filed with a court, which means the private key you scribbled into it stops being private the moment probate opens, right when your family needs it protected most. Keep the instructions for finding your setup separate from the keys themselves, and keep both separate from any document that becomes part of a public record. A second mistake, quieter but just as common, treating "I told my spouse where it is" as a finished plan. Telling someone where a hardware device lives isn't the same as that person actually being able to use it under pressure, grieving, with a screen full of unfamiliar prompts and a recovery window that may be limited. At a single backup location, one house, one safe deposit box, one drawer, is still one point of failure geographically, even if the access itself is shared. The holders who actually close this gap tend to do 3 unglamorous things: split physical backups across more than one location, write instructions simple enough that a technically inexperienced person could follow them without panicking, and revisit the whole setup at least once a year, because wallets get upgraded, hardware gets replaced, and a plan built around a device you stopped using 2 years ago isn't a plan anymore. Gap 1, closed. That's the layer most people who eventually build any structure at all start with, because it's the one that feels most personal. Nobody wants to be the reason their family loses everything. Now it gets more serious, because Gap 2 isn't about losing your coins. It's about the government already watching them. For years, the working assumption in crypto was that the tax authority had to take your word for it. That assumption just retired.
Starting with transactions from the 2025 tax year, brokers, exchanges, many hosted wallet providers, even certain payment processors are required to report your gross proceeds directly to the tax authority on a dedicated digital asset reporting form. Starting with assets acquired in 2026 onward, they report your cost basis too, the same way a stockbroker has reported your stock trades for decades. Crypto just got folded into the exact same reporting infrastructure as your brokerage account. Read that again because it's the whole ballgame. The era of "they probably don't know" is over. It's worth understanding just how wide the definition of broker has actually gotten, because a lot of holders assume it only means the big-name exchanges. It doesn't. The definition also reaches digital asset kiosks, the physical machines you feed cash into, and certain payment processors that route digital assets on your behalf, even if you never thought of them as a financial institution in the first place. If a platform is in a position to know who you are and facilitates the transaction, there's a real chance it now falls under this reporting umbrella. There's also a mechanical detail that catches people off guard. If you never gave the platform your taxpayer information in the first place, it may be required to withhold a portion of your proceeds automatically and send that withheld amount straight to the tax authority before you ever see it. Not as a penalty, just as a default safeguard for unidentified accounts. And every year, your tax return itself now asks a direct yes or no question about whether you received, sold, or exchanged any digital asset during the year, a question the tax authority can now cross-check against exactly what the brokers already told them, which is precisely the kind of mismatch that draws unwanted attention. Here's where it gets genuinely tricky. Say you bought Bitcoin on a custodial platform in 2022, bought more of the same coin in early 2026, then sold the whole position in one transaction. That single sale doesn't get reported as one clean event. The pre-2026 portion is a non-covered lot where the platform may or may not have reliable basis data. The 2026 onward portion is a covered lot, tracked and reported the way a stock brokerage always has. One sale, two different treatments. And if you don't know that split exists, you'll see a form that looks broken and assume it's an error, when it's actually just the transition rules doing exactly what they're built to do. Two more mechanics worth knowing, especially if you've branched beyond simply holding. If any part of your digital asset activity involves staking, locking coins up to help secure a network in exchange for rewards, those rewards are generally treated as ordinary income at the moment you gain control over them, valued at whatever they're worth that day, completely separate from whatever happens later when you eventually sell them. A lot of holders only think about tax at the moment of sale and get caught off guard discovering the reward itself was already a taxable event months or years earlier. And on the flip side, one rule that traditional stock traders live with, the wash sale rule, which disallows a loss if you buy back a substantially similar position in a short window, currently only applies to digital assets that are also classified as securities for tax purposes, a narrow category most Bitcoin holders aren't actually in. That's not a loophole so much as a gap in how the rules were written, and it's exactly the kind of detail that changes fast, which is why check the current rules before you rely on last year's version isn't a throwaway line, it's the actual operating instruction. I'm not a tax attorney, and none of this is personalized legal or tax advice for your specific situation. It's the landscape every custodial platform holder needs to understand before sitting down with a professional who actually knows their numbers. There's one more wrinkle worth knowing here, too. This reporting requirement generally applies to brokers operating in the United States. If you're using an exchange based outside the country, that platform may not be sending anything to your home tax authority at all, which doesn't reduce your obligation by a single dollar. You still owe tax on every disposal, regardless of whether a form ever lands in anyone's inbox. A lot of holders quietly assume a foreign exchange means less visibility. What it actually means is the same liability with worse paperwork, which is strictly a worse position to be in if anyone ever asks. The fix has three parts. Keep your own contemporaneous records, acquisition dates, cost basis, every transaction, independent of what the platform sends you, because basis reporting has been inconsistent through the transition, and a missing basis can default against you.
Know that moving coins between your own wallets isn't taxable, but every sale, swap, or disposal is, and it's now visible automatically on domestic platforms and still owed regardless of platform. And once your position is large enough that the exposure is material, a specialist stops being optional and becomes the cheapest insurance you'll ever buy. Two gaps down. If you've made it this far, you already understand more about what actually happens to Bitcoin after purchase than most people who've held it for years, some of them for a decade or more. Here's the one that only bites if this whole bet actually pays off, which, if you're still holding, is exactly the one worth planning for now, while it still feels hypothetical instead of urgent. Most of the developed world doesn't tax net worth at all. It taxes income and it taxes gains when you sell. A small handful of jurisdictions do something different. They tax what you already own every year, whether you sold anything or not. Norway charges a wealth tax on net assets above roughly the equivalent of $150,000, with a higher rate on larger fortunes applied to worldwide assets for residents, digital ones included. Spain layers a regional wealth tax above roughly 700,000 euros, plus a national solidarity surcharge on larger estates. Switzerland does it canton by canton, with rates that swing hard depending on exactly where you live. These aren't dusty relics nobody enforces. Norway's wealth tax pulled in billions in a single recent year, and it's actively reshaping where wealthy residents choose to live. A documented wave of entrepreneurs has relocated specifically to lower-rate Swiss cantons to cut the bill. It's worth knowing there's a second category too, quieter than a full net wealth tax, but still worth tracking if your position grows. Taxes that target specific categories of assets, rather than everything you own. A couple of major European economies replaced their broad wealth taxes years ago with narrower versions that only apply to certain holdings. One taxes net real estate above roughly €1.25 million and leaves financial assets like Bitcoin untouched entirely, while another uses a deemed return system that assumes a certain investment yield on your assets each year and taxes that assumed yield at a flat rate, regardless of what you actually earned. The practical lesson isn't which country does which, it's which categories of assets a given system actually reaches, because a country that looks wealth tax-free at a glance might simply be taxing a different slice of the pie than the one your Bitcoin sits in, and a country that looks like it has a wealth tax might not touch digital assets at all, depending on how the law defines what counts. And these thresholds don't stay put just because moving them is inconvenient. One government outside Europe recently cut its wealth tax entry threshold by more than 40% in a single legislative move, instantly pulling well over 100,000 additional people into a tax that didn't touch them the year before. Nobody there woke up planning for it. The line simply moved, and everyone above the new line was retroactively inside the system. That's the real lesson. It's not today's rate that should concern you. It's that the rate and the threshold are both variables a government can adjust the moment it needs revenue. An architect plans around variables. A follower plans around today's snapshot. Norway is the clearest real-world case study of what happens when that variable actually moves. When the country raised its wealth tax rate a few years back, it triggered more departures of ultra-wealthy households in that single year than in the entire prior decade combined, a level of movement large enough to become a genuine talking point in its own election cycle. The destination for a meaningful share of those departures were specific Swiss cantons, offering a strikingly different deal. Some cantons let qualifying non-working residents opt into a system based on lifestyle expenditure instead of income or wealth altogether, meaning the tax bill is essentially fixed regardless of what the person's portfolio actually does that year. That's not a loophole available to everyone, and it comes with real strings attached. Genuine residency, no local employment, a minimum spending threshold, but it illustrates the broader point better than any hypothetical could. When a government moves the number, the people most able to leave generally do, and they don't leave randomly. They leave toward the most favorable terms they can find. It's worth knowing this cuts both ways, too. Jurisdictions can move the line down, and a few have deliberately kept it at zero, which is exactly why they show up so often in relocation conversations for holders whose positions have grown large. Places like the UAE, Portugal, and Singapore currently levy no annual wealth tax at all, and no capital gains tax on top of that in most cases. That's not a recommendation to uproot your life. Residency has real costs beyond tax, and chasing a rate without accounting
accounting for everything else is how people end up worse off than when they started. It's simply the other end of the spectrum you should know exists before you assume your current country of residence is the only option on the table. There's one more distinction worth being precise about here because people conflate it constantly. A wealth tax and an inheritance tax are not the same instrument. A wealth tax charges you annually on what you own while you're alive. An inheritance tax charges your heirs once on what they receive after you're gone. And a country can have one, both, or neither. Take one of the zero wealth tax jurisdictions mentioned a moment ago. No annual charge on holding assets, but a flat stamp duty that applies specifically to heirs outside the immediate family, meaning the exact same portfolio can pass to a spouse or child, essentially untouched, and pass to a niece, nephew, or unrelated beneficiary at a real cost. This is precisely where the custody layer and the jurisdiction layer stop being separate conversations and start being the same conversation. A trust that correctly names your digital assets solves nothing if it's drafted somewhere that taxes the transfer heavily, and a jurisdiction with a favorable inheritance regime solves nothing if your heirs can't actually locate or access the wallet in the first place. The three gaps in this video aren't really three separate problems. They're three angles on the same underlying question. Does this asset actually reach the people you intended for, intact, on the terms you chose? This isn't only a European story anymore either. In the U.S., a ballot measure now moving through California would impose a one-time levy on the net worth of billion-dollar residents. It's worth knowing this wasn't dreamed up overnight. It was drafted with input from economists at major public universities, and the state's own legislative analysts have projected it could raise tens of billions of dollars beginning within a couple of years of taking effect, while simultaneously acknowledging that some billionaires would likely leave the state entirely, which would claw back a meaningful share of that projected revenue through lost income tax alone.
You don't need to be anywhere near that threshold to see the direction of travel. Policy conversations right now are trending toward taxing what you hold, not just what you earn. When a proposal like that gains real traction, the wealthy respond immediately. There was public reporting on major founders quietly unwinding dozens of asset-holding entities out of the state the same year that measure gained momentum. Not panic. Architects reading the blueprint before the walls go up. Run the math on your own situation for a second. A resident sitting in a $2 million position in a jurisdiction charging just over 1% above the higher threshold isn't paying $20,000 or $30,000 once. They're paying close to that every single year the position stays above the line, whether a single coin gets sold or not. Compound that over a decade and it's not a rounding error. It's a meaningful slice of the position itself, paid purely for holding it in the wrong place. Now push the same math further out. If that position doubles again over the following decade, as long-term Bitcoin holders have generally hoped it would, the annual bill doubles right along with it, silently, without a single sale ever triggering it. The tax scales with your success, which is exactly why this is the layer people underestimate the longest. It does nothing while the position is small, and then compounds hardest right when the position finally matters. Compare that against a capital gains system, which is the default almost everywhere else. Under a pure capital gains approach, that same $2 million position could sit untouched for 30 years, appreciate the entire time, and generate zero tax liability until the day you actually choose to sell. And even then, only on the gain, not the whole balance. That's the entire structural difference in one sentence. A capital gains system taxes a decision you get to make on your own timeline, while a wealth tax taxes a fact about your life you don't get to opt out of just by not selling. Neither system is inherently right or wrong, and this isn't a case for one over the other. It's simply the reason residency and asset location matter so much more for a fast appreciating holding like Bitcoin than they do for, say, a savings account earning a fixed rate that barely moves the needle either way. The fix isn't move to a tax haven tomorrow, and if anyone tells you it's that simple, be skeptical. It's building optionality before you need it. Know in advance which jurisdictions tax worldwide assets versus only local ones. Know that residency triggers are usually tied to physical presence, commonly around half the year, plus other ties like a permanent home, not a stamp and a passport. And if your position ever grows large enough to matter, have a relationship with counsel in more than one country before a policy shift forces the search. That's jurisdictional diversification in its simplest form. Not hiding from anything, just refusing to let one government's decision be the only variable that determines what you keep. 3 gaps.
Let's put the whole shape back together because it's easy to lose the thread across 3 separate stories and 3 separate sets of specifics. Layer 1 is custody. The asset survives you through shared access, clear instructions, or a trust that actually names digital assets instead of pretending they don't exist. Layer 2 is visibility. The reporting infrastructure has caught up to traditional finance, so you build your own records instead of hoping the platform's paperwork saves you. Layer 3 is jurisdiction. If this position works the way you're hoping, growth itself creates new exposure, and the moment to understand that exposure is before you're standing inside it. None of this requires distrusting Bitcoin. It requires you to stop treating Bitcoin as the entire plan and start treating it as the raw material the plan is built from. A follower buys the asset and calls it done. An architect buys the asset, then builds the walls, the access points, and the exits around it, deliberately, on their own terms, long before anyone forces them to build it in a panic. Notice something about all 3 gaps if you look back at them together? None of them are about picking the right asset. They're not asking whether Bitcoin was the correct decision, or whether some other coin might have performed better, or whether you got in at a good price. All 3 live entirely downstream of that decision already having been made. That's exactly why they get ignored. There's no dopamine in fixing a custody gap, no chart to watch, no candle to refresh. Structure is boring in the exact same way that good insurance is boring. You notice it either never, or on the single worst day of your life, and there's no in between. The entire premise of this channel is that the boring layer is the one actually worth your attention, precisely because almost nobody else is willing to sit still long enough to build it. And this isn't a conversation reserved for 8-figure portfolios with a family office on a retainer. The custody layer matters the moment you own any amount you'd be devastated to lose, which, for most of you watching, was true from the very first coin. The visibility layer matters the moment you have a single taxable transaction on a custodial platform, which is nearly everyone who didn't mine their first coin by hand back in 2010. And the jurisdiction layer matters earlier than you think, precisely because the whole point of building it early is that it has to already exist by the time your position is large enough for the stakes to be real. Wait until you need the structure and you'll build it under pressure, in a hurry, on worse terms than if you'd built it calmly years before it felt urgent. Every one of these 3 layers costs far less to build now while the position is manageable and the decisions are calm than it will ever cost to build later, under pressure, with lawyers billing by the hour and a deadline already bearing down on you. That ordering, cheap and calm now versus expensive and rushed later, is really the entire argument in miniature, and it applies whether your position is worth $1,000 or $10 million. Hit subscribe. We don't follow the market, we design the moat. In a world of followers, we are the architects of our own freedom. Holding the asset was never the moat. The structure around it is the moat, and a moat you never actually dug is not a moat at all. It's just a nice word for wishful thinking. If one of these 3 layers is already built for you, tell me which one in the comments. My guess is most of you have exactly one, and almost nobody watching has all 3 yet. That comment thread alone will probably teach you more about where the gaps really are than a dozen more videos on the subject, because the honest answers in a comments section tend to reveal a lot more than any survey ever could. The next piece in this series pushes the custody conversation even further. What happens when you try to hold Bitcoin inside a self-directed retirement account, where the rules around control when prohibited transactions get a lot more particular, and one wrong move can cost you the entire tax advantage you were trying to protect in the first place? I'll see you there.